Welcome everyone. Thanks for joining us today for our discussion on delivering crypto trading to retail investors. Where should brokers start? My name is Nikolai. I'm from Finance Feeds. I'm here with executives from several companies in the fintech and cryptocurrency spheres. Joining us today is John Light from Devexperts, John Willock from dxFeed, and Henry Price from GCEX. Welcome, guys. How are you?
Good. Nice to meet you.
Thanks for inviting us.
Thanks. Yep. Gentlemen, so thanks for taking the time to speak with me today. I wanted to start off real quick. If you guys could give us just a really brief background of what you guys do at your respective companies, so the audience has a general idea of your expertise.
Yeah, sure. I'll start. So I'm John Light. I'm VP of Trading Solutions at Devexperts, and we specialize in the development of financial software solutions and services across the global capital markets. We serve retail and institutional brokerages, wealth management firms, and exchanges. We were founded in 2002, headquartered in Munich. We have development offices all over Europe, and we have sales offices in all of the financial centers that you'd expect: London, New York, and Singapore. And we have over 600 engineers working across our products. Now, our products support foreign exchange, CFDs, crypto, equities, futures, and options. And we can offer a complete solution from web and mobile platforms, back-end trading engines, integrations into market participants, and all of the tools that an exchange or broker would need to manage their business. This can be taken as a SaaS platform or a full enterprise deployment. It's also quite modular, so you can take what you need and pick and choose. Specifically for crypto, we can provide complete platforms for both crypto margin, crypto CFDs, as well as crypto spot with multi-currency accounts. And we can cover back-end engines for both brokers and exchanges. We have a portal that allows your clients to initiate crypto deposits and crypto withdrawals, as well as facilitating some KYC checks. And we also integrate into exchanges, liquidity providers, custodians, wallet providers, CRMs, whatever is needed for your particular crypto solution.
John Willock.
Hi, so I'm John Willock. I'm a board advisor at dxFeed, which is a division of Devexperts. It's the market data side of the business, focused on the actual content from originally what would have been securities markets, things like equities, indices, fixed income, things of that sort, but also increasingly able to provide data into the crypto sphere as well, or collect data from it. So that would include things like spot prices, futures products that you might see on certain exchanges, and also interpreting data from that to produce things like either indices or analytics to be able to better describe to a user what exactly is taking place in this market, and giving them the tools within also the software platforms that John might mentioned, and other platforms as well, to essentially power their trading solutions from a content perspective. And that includes distribution to everyone from a retail end user who might take some sort of web display product through to institutions, but also increasingly also towards the actual consumption within the crypto sphere through tools like Chainlink, for example, which distribute data to smart contracts.
Cool. Thanks, John. Henry?
Yeah, so I guess I'm the non-Devexperts guy. So GCEX was founded in 2018. It's kind of the continuation of Lars Holtz in his career from Saxo up to more recently CFH, which he sold in about 2017. We then decided to kind of expand the prime model to crypto. I was brought on as the original crypto guy, so I managed the vendor relationships and how we manage crypto. So we're an FCA regulated and digital asset registered provider of digital asset services. So then there's not very many of us. So that's how we're going.
Cool. Thanks, Henry. So guys, let's jump right in. My first question is for John Light. So now that crypto is basically mainstream and existing brokerages are offering to their clients, I guess the introductory question is why is the crypto asset so different for what we're used to in fiat assets from a technology perspective?
Yeah, the beginnings of the crypto market are unlike any other financial asset class. The first adopters were not large institutions, but they were techies that had a passion for cryptology and retail users that were excited about the use case early on. As such, the trading technology and standards started out in a very different way to what we're used to in the traditional markets. The initial trading venues were not built and run by big institutions with expertise in the area, using existing software and considering all of the factors that we would expect in a regulated marketplace. The original exchanges were not built on financial grade technology, agreed standards, security, testing, and experience gained from other financial markets and rules from regulators governing the platforms. One example that I like to give is Mt. Gox, which was one of the most famous original exchanges, which at its peak in 2013 was the largest Bitcoin exchange ever in terms of market share. It was handling over 70% of the world's Bitcoin transactions. Just 1 year later in 2014, the exchange was filing for bankruptcy. Now, Mt. Gox didn't actually start out as a crypto exchange. The name stands for Magic the Gathering Online Exchange. And Magic the Gathering are a series of fantasy playing cards. And the exchange was originally built by a programmer where these fantasy playing cards could be transacted. They were virtual fantasy playing cards. Now, that exchange didn't really take off. And a few years later, the owner heard about Bitcoin and he realized there was a need for an exchange. So he repurposed that exchange, keeping the same name. It was obviously adapted for crypto, but it didn't have the technical and security requirements needed. And this led to database leaks, security breaches, theft, fraud, and huge transaction delays, some reportedly into weeks. And then after one large hack that resulted in a really large number of missing Bitcoin, I think over 850,000 Bitcoins went missing, it ended up filing for bankruptcy, and the cleanup still continues today. Now, the history of the original technology behind quite a lot of crypto providers is similar across some of the other exchanges. They were built by techies and they successfully created crypto platforms, but they didn't necessarily have the experience, the resources, and the financing to build robust platforms for financial markets. Key considerations like execution methods, standards, and APIs had been reinvented and in some cases completely skipped. Now, most of the big exchanges have overcome these hurdles and they do work the way they should. Although only last week there were reports of outages at one of the biggest and most funded exchanges. But the point here is that it started out with people doing things in completely different ways, some of which were groundbreaking and some of which needed major reform. And there's been a lot of development in this area, but there's still lots of things that can be improved. And aside from technology, there's a lot of focus on custody, which we'll discuss later. There is the need to hedge. An institutional firm is not likely to go into an asset without being able to hedge it. And then you have differences in regulation and KYC, and crypto liquidity, for example, is a long way off from what we're used to in FX. It's not easy if you want to trade a large amount of crypto without causing underlying changes in the price.
I see. And John, so given these somewhat stark differences, right, in technology behind cryptocurrencies and traditional fiat assets as we're used to them, so what are the key nuances that new and existing brokers need to consider when planning and offering rollout?
Yeah, so let's take protocols as an example. They need to be straightforward for an institution to integrate into an exchange or LP or OTC market maker. Ideally, the protocol is something that institutions have experience in, such as FIX. But most of the crypto exchanges, they started out with just a user interface and they added an API later on. A lot of these are their own protocols built from scratch. They all are different from each other and lots have stability and scaling issues. Also, security weaknesses at some of the original exchanges showed how vulnerable some of these early systems were. Firms need to trust that the assets are secure on the platforms that they're being executed on. And security covers a vast area, and we've added, full support in our platform for such things as multi-factor authentication, secure connections to custodians for crypto withdrawals and deposits. One major difference that we've seen with crypto compared to FX is how brokers want to charge financing for the open CFD positions. In FX, we do this once a day with a swap, and it doesn't have to work that way in crypto. So something that we've added into our platform is the ability to charge financing at more regular intervals for holding a position in crypto and using a simpler percentage model. This is something that brokers might have trouble with if they're adding a product into an existing FX platform. And then finally, we all know the crypto market is highly volatile and fast-paced. It often leads to wild pricing. So it's really important to have a reliable data feed for both the clients and the broker, especially if the broker is running a B-book.
And John, you just mentioned reliable data at the end there, and I was wondering if John Willock can elaborate on how brokers can actually overcome some of the challenges they face in assessing the value of the data that they're getting.
Absolutely. I think it's a very fascinating area because when you consider what John Light was just saying about some of the platforms, there's also a lot to consider around what you are then able to interact with as far as qualifying some of those venues from which you might source data. So if you look at, for example, the 10 largest exchanges, there may be regulatory reasons or strategic reasons that you choose to work with them or to not. And so to understand what prices you're actually looking at as far as what source they're from, and therefore if those are something you could consider executable, is critical. And so when you go and select your data to really actually parse through the core content source, the qualification of that content, determine things like your best execution rules, if that's something you're subject to in your jurisdiction based on achievability of those prices, is critical. That aside, things like some reference data about the assets that you're looking at can be also extremely important because you have to understand what are these products. Are these products that have a certain characteristic that's suitable for your investor mandate? Are these products which are fully decentralized, or are they something that may have an issue or in some capacity? And that kind of reference information includes a lot of fields that might be very new and very different from what you're typically used to looking at when you're qualifying other assets. This isn't something that you can typically value, for example, based on some sort of discounted cash flow with dividends, because these are not generally assets that have that. But they may also possess some sort of staking or other rewards, which you could consider to be a passive income source in the sense of a fixed income instrument to some extent. Combined with a number of different analytics that can also be built off the back of this, you can produce a good sense of, let's just say, market volatility, understanding as to whether or not a given moment in time is the right time to get into an asset class, just given whether you've seen a lot of tumultuous times just in the recent past, and whether that's something that's likely to continue, or whether it's perhaps either a flash in the pan moment or a sustained moment where things have calmed down. You can determine that now is the right time as far as price is concerned to execute a transaction and begin to enter it. And I think measurements of liquidity, as John Light was saying as well, that can be derived from looking at some of the data, some of the depth of book metrics that can be looked at, some of the spread characteristics that can be analyzed from the various venues, can really help with that decision-making process as well. Not just how you would place that order in terms of selection of venue, but also how you would like to break up perhaps a larger order, because there are in fact liquidity issues, as was mentioned, just with respect to each of these venues. You can go and do what you might have in equities and press a button on a single $1 million trade without possibly blowing out some of those exchanges and filling your price at a much more unattractive rate than perhaps you would have thought if you naively just were to look at some of the spot markets. And I'll also throw in something that I think has been talked about in a lot of articles recently, but it is worth mentioning just to highlight here. Again, with venue selection, there have been accusations with certain venues about falsification of the trade volumes that they have. right? So that kind of information, because these are typically very heavily, traditionally, at least thus far, unregulated venues, can mean that your qualification of that source of data can be paramount as far as understanding not just am I able to trade there, am I willing to trade there for various strategic and technical and also regulatory reasons, but when they tell me they've done $1 million or $1 billion or whatever dollars worth of volume in a given period of time, is that actually achievable to a third party who wishes to transact there, or is that actually a false set of data? And amusingly, this is typically how volumes are used to rank exchanges on leaderboards in order of largest to smallest, and that actually is a very poor metric for typically measuring the liquidity of an exchange or the competence of an exchange. There's a lot of other data that needs to be looked at, including things like the depth of book and the quote quality that you can look at from that perspective rather than the post trade.
Well, John Willock, definitely a lot of things to consider there on the data side. Thanks. It's very interesting. So guys, crypto is an interesting asset class, right? I think we could all agree, because it could also be offered in different ways in terms of settlement. And Henry Price, I'm wondering if you could sort of talk a little bit about what are the, what types of offerings brokers should consider from a settlement standpoint when they want to launch crypto?
Yeah, I think it's interesting how John briefly mentioned perpetuals, which is kind of the crypto native version of a swap. It provides it's kind of it's called a perpetual swap. So it kind of provides high leverage to the clients. It's kind of fairly retail. The margining's maybe every 6 hours, or financing's every 6 hours, 8 hours, depending on the instrument. I would say they're like come from the blockchain world. You then kind of look into what kind of, I would say, brokers generally consume, which is a CFD product, which is a MiFID instrument, which has its own pros and cons. And then there's the spot product. Then there's also derivatives like options and stuff, but let's stick it to these things. So I think when managing any of these kind of types of instrument, you've got to consider the actual compliance overhead. Which is in the case of maybe you want to trade a MiFID instrument because you have the regulation to do so. Maybe clients, they may actually want to trade a MiFID instrument because they know there's certain assurance there, but you may need a license to trade the instrument. Crypto spot is generally outside the regulatory perimeter, but in the UK, for example, there is a digital asset register. So you then have to apply for a very specific license to deal with spot digital assets. So there's kind of just the regulation side. Then there's kind of a compliance overhead. So a lot of brokers choose to basically move into CFD products initially, because it's kind of a continuation MiFID product from what they're offering in FX. But if you do choose to go down the route of spot, you will need to kind of invest in a compliance officer who's familiar with what I would call on-chain analytics, or we can't call it KYT, which is know your transaction, not just know your customer. There's kind of a lot of information on the blockchain which needs to be considered when you take delivery of an asset. And then I think there's just, in generally speaking, there's sort of the technical aspect of handling a spot product. So that could be a choice of custodian. And again, markets are not completely regulated. So there's quite a few custodians out there in various jurisdictions that can handle the asset class. But, then you've got to understand that each blockchain may have different support requirements. So Bitcoin is usually supported by most or all custodians. Then you kind of move down to Ethereum, and they kind of go into ranking popularity. So if your client wants access to something like Dogecoin, it will be much in your interest to kind of take a CFD version of that rather than try and get a custodian with support for that. So yeah, hopefully that's kind of the overview. I would say there's kind of a technical hurdle, there's a regulatory hurdle, and there's a compliance understanding hurdle. And a lot of the gateway stuff is to do with a derivative product like a CFD. The only additional thing that can go wrong there is that there can be sort of asset class specific events that will tune the financing. It occurs in the swap and perpetual swaps as well, but you may understand you're holding an overnight position, and there's like basically a crypto asset dependent situation that goes on, which so there's a lot to take in the more you go down. So, but pros and cons. For example, the FCA has actually banned CFD products for retail, so the spot is only available to you. But it's a bit there's lots to consider.
Sure. And Henry, if we can take a step back and think about the importance of data that we just discussed with John Willock, and what you have just described in terms of the different ways that crypto can be offered, how do these things play into the ability to hedge and manage risk for companies today?
Yeah, so obviously if you have access to the underlying and you can trade that, then you can actively hedge, and the markets maybe you won't be afforded leverage, but you can definitely hedge your flow. A lot of the CFD products are leveraged, but you've got to understand that, I mean, 1 to 5 would be quite good leverage for a volatile product. 1 to 10 would be very aggressive. And then if you go to the perpetual swaps in the retail market, they're much higher, but these wouldn't be institutional grade products, if that makes sense. I think just keep track of the volatility. And again, you could have the margin requirements changed based on the volatility, which is, so you can't overutilize your margin requirements in these markets as much.
Mm-hmm. And Henry, also to you, I think John Willock mentioned market disruptions previously, and I think we all know that certain market events do happen with crypto from time to time. For example, such things as like halving, right? Can you talk a bit more about such disruptions and how they impact crypto offerings, and how can brokers actually deal with such events?
Yeah, so halving, you specifically, I'll just address that one. So in the Bitcoin protocol, approximately every 4 years, but it's kind of based on how many blocks, they basically halve the reward for miners. Such a event is not really a disruption. It may cause people to get excited because it's kind of, oh, people are interested in that event, but that's kind of fully embedded in the blockchain protocol itself. So I call them like protocol-based returns. So they're fully planned, you know exactly when they're going to occur within reason. And that's usually all good and proper. So what we're kind of more concerned about is, I would say there's 2 big things, I guess, to look out for if I have to like specifically say 1 or 2. What I would call a hard fork. And a hard fork essentially is when you have a blockchain and it goes along kind of building blocks. And at some point, I would say the architects of the solution, or they usually call something like Ethereum core, Bitcoin core, they decide that an upgrade needs to be processed. And this upgrade at this point causes the chain to become incompatible with the previous. So there is actually, you can't keep going. It's like using, Windows 95 when you've got a Windows, whatever they are on now, or even worse, it's like a Mac. So basically there's a huge change in the code base, and there's 2 versions of reality now. This occurred after something called the DAO hack. I mean, it's better to look it up, but it's essentially what happened there is, they decided to roll back an event. So they made an irreconcilable change to the chain. And there is still Ethereum Classic and Ethereum knock on like this, and they have different values. So in most, what we say, vendors, they kind of have a hard fork policy, which explains whether you'll be entitled to both assets, which is also an interesting property to decide, which one is the true Ethereum, because again, there isn't really, except the market value on those, that's all you can do. But if there is an event like, for example, the London fork you may have heard of with Ethereum, that's part of the Ethereum improvement program, the EIPs. So what that is the same thing, but we're all kind of in agreement that this is a good thing for the network. So at this point, you may get this kind of uncertainty in settlement because you don't know which chain you're on. So what we did is we will basically not settle any cryptos on chain for about 6 to 12 hours, depending on how we feel the disruption is. At the very high end of this, there may be actually big problems with confirmations and stuff, which could hold. You just basically don't want to settle when the chain's in flux. The other main, I would say, big type of event that's very crypto specific, other than a protocol change or a hard fork, is the what I call them airdrops. But essentially, there are token drops or airdrops. So it's basically tokens added to a wallet. So for example, there's a big one in XRP, Ripple XRP, where everyone who had an allocation of Ripple had Spark allocation allocated to them. It's like it's just in proportion to what you hold. Now, what that did for financing rates is quite interesting because there was obviously a convenience to holding the underlying. So the rates went crazy. So if you could borrow Ripple and hold it in the spot, you would then get this reward. So that's a very weird specific, it's not like a hard fork, it's not a protocol change, it's just essentially there is a weird property of holding the underlying, which causes interest rates to spike. So if you had a CFD position overnight, that would be quite problematic. So again, you need to stay in tune to the news around that might affect your services. But custodians and LPs are getting far better at kind of informing the clients of such events. So,
Well, thanks for the explanation, Henry. John Willick, if I could come back to you, and really my question is, can you tell us what types of data are crucial for companies to have in order to prepare for some of these events that Henry just described, like the airdrops and the halvings and other events?
Absolutely. I think a lot of what was just described with respect to some of these various asset splits and deliveries, it comes down to what would traditionally be called corporate action type information. And as far as things like the halving events, I'll call that reference data to a certain extent. And again, a lot of those, as far as halvings and other protocol level events, those are hard coded, predetermined well in advance. You can prepare for this. You can put this in your calendar and set a clock to it as far as your valuation, as far as your observation of periods of risk change or any other implications that may have for you, the total supply of a given asset, right? How many asset units are issued and outstanding, to use that terminology. And what that inflation rate might look like, for example. So those systematic ones are much more straightforward to understand. But collecting that information is something that isn't going to be offered from source in a standardized format. So there's a lot of work that can be done by various data providers to go and interpret, let's say, something like a white paper and make that into a data table that's absorbable and interpretable by somebody who's looking at it from a more sort of typical finance perspective. With respect to what I'll call the rest of these corporate action type events in terms of splits of assets where you have a hard fork and you have either something that might be called, as they say, contentious or non-contentious in terms of that change, where you may end up with two assets, or you may end up with an uncertainty as to whether or not that particular fork may be called successful and therefore actually take place at a given point in time. That's something that is again very tricky, because that information, as far as this taking place, this expectation of these events, is generally not published in a traditionally interpretable way. As far as that could be something that's published to an internet forum, that could be something published to another community group of some kind on some sort of web platform, that could be announced on a Twitter feed, for example. And so recognizing when that information is becoming available, interpreting that in such a way that you can provide that downstream to the brokers or other market participants who need to understand this for their assessment of what is taking place for their clients, requires some additional work. And also for some of these things, like as Henry was saying, some of these airdrops, or again, even the aspect of the forks, the value of the asset, or even possibly your ability to physically go and access the asset that may have come to you, is something that may require some other qualification of the utility or value of that information, because you may have to conduct some sort of, let's say, on-chain retrieval of that asset by exposing your keys to a new piece of software. So just to give a quick example, there have been various forks of the Bitcoin protocol where somebody has just randomly come forward and said, we are going to issue a new iteration of it. To acquire the asset units, you must come and insert your keys into this particular core piece of software to then retrieve the assets applicable to your keys. In doing so, you may have to put your keys at risk into placing it in the software, and you may therefore take that as an interpretation that these assets, although available, are not attractive for me to go and acquire, because I cannot afford to place these keys that are otherwise very important and very well protected into some, as of yet, unclear as far as its safety and certainty software. And there were, in fact, cases where that sort of thing was actually really a scam in some form, to go and have people place their keys at risk and copy and steal from those keys. So that kind of additional interpretation information, aside from just the factual restatement of that information and distribution of that information, adds another whole layer of complexity, where you would never imagine in traditional markets that somebody says, you can come and get your dividend, but you have to give me your personal information to do so in such a way that I might be able to go and claim your identity or something like that. It's a very different universe when you draw those sorts of parallels for comparison.
I see. John Willick, thank you for that detailed explanation. So guys, given the different types of crypto offerings that we're discussing today, both from a tech and settlement standpoint, I think John Light, this one's for you. What do decision makers need to think about or need to know regarding accepting and storing crypto assets from customers, once their offering is launched?
Yeah, I mean, there are a lot of risks with holding crypto in wallets or directly on hard drives. We've all heard those stories of people searching rubbish dumps and losing crypto between wallets. The recent increase of offerings around insured and secured crypto custody has really helped institutional firms get more comfortable in this area. You wouldn't expect institutions to store kilograms of gold in their office filing cabinets, and they certainly wouldn't want to be storing crypto without it being protected and secure. With crypto custodians, there are a lot of different options, ranging from basic online wallets through to institutional custodians that offer secured custody where they'll actually hold your crypto and insure it. A lot of these are regulated, and they use methods such as cold storage on HSMs, where the crypto is stored offline away from being hacked, and other issues around storing crypto online. Obviously, this comes with a fee, but because of the measures that they take, they've managed to get insurance policies of some of the largest underwriters. And I think the rise of these institutional grade crypto custodians is the #1 reason why we've seen more and more interest from institutions getting into the crypto space and being comfortable with that. Certainly with both crypto spot and crypto CFDs, at some point, a broker is definitely going to need to take a look at the wallet and custodian options out there. For a crypto spot broker, it's obvious the crypto that their clients are buying and selling need to be held somewhere, and depending on the regulation, this may need to be with an insured custodian. And even if the regulation doesn't dictate it, it's a good idea. These accounts need to be multi-currency and support all of the currencies on offer, and they need to be linked up with the wallets. But one interesting thing that we've seen is that even those brokers offering crypto CFDs that initially think that their clients will fund their account with fiat currencies, they soon start looking at being able to offer deposits and withdrawals in crypto due to client demand. For this, the trading platform will need to interact directly with the wallet or custodian for both generating addresses for deposits as well as triggering withdrawals. And there are lots of options in this space and lots of differences between the custodians' offerings.
Cool, thanks, John. Henry, you had previously mentioned sort of the temporary ban in the UK on retail crypto trading. Can you tell us, in your opinion, like, how can such regulatory challenges that exist today be overcome with really the solutions that we're talking about today for crypto?
Yeah, so in the UK, you're allowed to trade. I think. Well, I'm not a lawyer, so I can't give you any full advice. But the main problem with the SCA was the CFD products and derivative instruments on crypto. So that was the specific thing in place. So that also affected people who had even pension stuff access to crypto. So they were basically saying you can't, as a non-professional or a non-institution, you can't can't buy these instruments. So yeah, I think as it stands, it's still quite a lot in flux, and you kind of hear a lot of things about the news about El Salvador or whatever legalizing it. So, but in my little world, I kind of basically, there's a few terms you kind of get your head around. It's kind of mainly there's anti-money laundering regimes. So European and the UK especially is essentially, that's what the digital asset temporary register is, which is what GCEX is on, is specifically kind of more related to AMLD5. So they're focused on the inflows and how do we prevent money laundering in the space. America and Singapore and these other kind of institutions, they're kind of focused on a travel rule like approach. So travel rule in the traditional sense is when funds are moved from financial institution to financial institution, there is essentially metadata attached. I mean, I don't know how more simple you can say without being oversimple, but essentially when I transfer between what they call virtual asset service providers, they're called VASPs in some context, you might hear that word. You need to say, look, this is the client, this is what we know about you. So basically the money can be traced through different institutions. And yeah, essentially when you put crypto into an omnibus account, it essentially mixes everything together. So the best mixer is to move everything into an omnibus wallet. So again, as long as you are prepared to do things properly and prepared to look over the compliance issues surrounding, I would say, those two main issues, money laundering and also these travel rule things, essentially assigning identities to transactions as they go in, then that's your best defense. But again, this is a kind of an emerging new asset class, and different jurisdictions have different approaches. And yeah, just bear in mind that you may have to hire a specialist compliance officer to deal with these assets when they come in. But it's all surmountable, and there's more and more specialist tools like Devexperts, but there's also more specialist advice and brokers. So I think it's definitely improving for people, whereas I got in 5-6 years ago when there was nothing. So it was completely on its own.
And Henry, am I understanding, just as a follow-up, if I'm understanding correctly, brokers should be prepared for, depending on the jurisdiction, of course, like you mentioned, that the crypto assets in terms of their storage and customers, they should expect that they would have to have the same sort of requirements as they do for traditional fiat classes today.
Yeah, so this is the main one, is that it's not even in the UK, it's not fully inside the regulatory perimeter, but they have to undergo KYC and KYT on transactions. So yeah, you're assumed to be under the same permissions as AMLD5. I would just say that, yeah, using a third-party custodian may assist in some of the overheads there, because obviously you're kind of beholden, or you're using their policies and their expertise. So when funds arrive in your wallet under a custodian, you could be kind of writing their expertise. So they'll have their own anti-money laundering procedures in line with regulations. So they will either hold funds, or they'll basically do some of that for you, depending on the services you buy.
I see. Thanks, Henry. Guys, thank you for your very informative insights. I'd actually like to turn it over to our audience. We have quite a few questions that came in during our discussion. Henry, I think this one's for you. I know this is probably a very subjective question. Eric in the audience is asking, how can brokers choose a good liquidity provider? Since you are on that side of the fence with respect to the services that GCEX provides, perhaps you can tell us your opinion.
Yeah, so we're an institution-only liquidity provider, prime model. So we're aggregating LPs from the space. I would say if you're looking to hedge flow from kind of aggregating flow, hedging it, look at not just the spreads themselves, but the depth, because again, you may actually also find that a lot of the retail brokerages you know and love are not actually price discovery venues either. So again, there are kind of large entities. I think a few came out. One big entity in FX came out this week saying they also do crypto. So these guys are kind of market making at a level which is beyond the normal retail exchanges. So again, deep liquidity, regulation and compliance, which is obviously key. I think whether their custody and their, so we kind of have third-party custodians, so we keep everything separate from the main business. And then I think as long as they're regulatory compliant, they understand the technology, the custody of it, you then need to look at the team and decide whether either they speak your language or they have a track record in finance. So, and then also any kind of serious fiat off-ramping required essentially requires quite a status in the industry, finance industry, to basically get it passed. So if they have a long track record of being regulated or super compliant, then they can usually get banking relationships with top tier banks for fiat off-ramping, not just liquidity. So if they don't have payment rails, then you'll kind of be stuck in a tether world, which is not appropriate for a traditional finance broker. So yeah, payment rails, regulation, look at the team's back test, and then just focus on depth, not just the spreads. And remember, this asset isn't always regulated. So like other John said, they could be double booking, and you don't know. They don't have to report exactly as you would expect. So.
Cool, thanks, Henry. Another question that came in from Kathy Lau: can the Devexperts crypto platform route to two different liquidity providers? John Light, I think this is a question for you.
Yeah, certainly. So our platform is built on upon our our existing frameworks. So we're able to route trades to different liquidity providers. So maybe you have one liquidity provider that's providing top 10 pairs, and you want to route altcoins to somewhere else. So we can certainly do that in the platform, no problem.
Oh, cool. There's also a question here about dxFeed. John Willock, if you could. Nora Bedin asks, is the dxFeed does dxFeed only provide pricing? And what is the instrument? What kind of instruments in terms of crypto CFDs are being offered?
So I think there's a couple of answers to that. So within the dxFeed and Devexperts group, the dxFeed, which is my side of the business, provides the pricing information. So we are not involved in actual order routing activity or creation of the products, the CFDs themselves, things of that sort. We're only essentially documenting the truth and providing quantification of that and sending it out through various data feeds and things of that sort to platforms which are operated by the bank's brokers, whomever it might be, to then utilize as they do. That would be the business of, for example, Henry, and using the technology, for example, that John Light has described that Devexperts side of the business offers. So perhaps I'll actually direct the CFD component to Henry to answer, but I guess just to say from the data perspective, the data would be used, generally speaking, to produce the sort of the price metrics of a CFD, but is actually not itself an instrument to be traded. That's done by the broker.
I see. Thank you. We have another question here, John Light. I think this is regarding payments. How many fiat payment methods does Devexperts have connected?
So as I mentioned in one of the questions, one of the most important things that we've seen from both obviously spot and CFD brokers is the ability to be able to connect into wallet providers and custodians. So we actually have our own API for this that can process deposits, withdrawals, update messages, and things like this. We've integrated into like the biggest three most popular custodians, and for Devexperts integrating into other custodians, wallet providers, and payment interfaces. It's what we do every day. So even if it's not there, it's not normally a big project for us.
I see. Thank you. And guys, not sure who to direct this to. Mahmoud asks, what is the throughput that can be handled by Devexperts exchange platform?
So it really, I can answer that one. It really depends on the model that's being set up, the way that orders are routed, the way that orders are handled. We actually have two different matching engines for our exchange platform. One is a more basic one, and we have a high throughput matching engine as well that we can offer. So I'd say maybe get in touch and we can do some we can discuss the different options available and what you're looking for. And it's hard to put a number on out, you know, from no information.
I see. There's also a few questions here about what is the latency of the platform? Does Devexperts offer CFDs on cryptos 24/7? And how many products are currently offered? I'm not sure, John, do you want to elaborate on this now?
Yeah, I can go through those. So latency of the platform, again, is, you know, there's no hard answer because it all depends on how it's set up. Our system can be multi-node, so we can, as well as scaling vertically by adding, you know, more RAM and processing power to our application, we can run multiple nodes, so we can horizontally scale out that. So, you know, we might split out different currency pairs, different client groups, and things like this. So depending on the hardware that's been put on it, depending on how the system is configured, what kind of processing needs to be done, we have latency kind of in single digit milliseconds, and it can go higher if there's more processing or margin checks and things like this that need to go onto the what was the other question? Yes, so does Devexpert offer CFDs on cryptos 24/7, and how many products are offered? So yes, we have a crypto CFD platform. It can run 24 hours, 7 days a week. We offer that in two different modes. We have a SaaS service. So in that configuration, we run the software for you. We host it for you. We give you the tools to be able to run your brokerage. And also we support that system for you. So we have 24-hour monitoring. We have a team of people making sure everything is running properly. With regards to the products that are offered, it's unlimited depending on how many CFDs you want to add in. It doesn't matter too much to us. It's just a technical platform.
And Henry Price, would you like to add to this with respect to different crypto products and things like that?
I can only really speak about our platform, but I would say we're pretty extensive. So we have literally 4 custodians to try and support as many tokens as we can, but they have to meet what I would say are our approval requirements to be custodians for us. So it can't just be anybody. So if you wanted to source spot liquidity and then custody it, you're kind of usually fairly limited in the custodians you can use. So I think we offer maybe 16 up to maybe, they kind of go on and off, but up to maybe 20 CFD products, but maybe only 10 of them will be supported for spot delivery. So you can trade them, you can even trade them as spot, but we can't deliver the underlying, in what I would consider a secure manner. So this is the kind of usual top end limitation, but they're usually 24/7. And then kind of financing is usually charged in like a sensible manner, like end of day, not every 6 to 8 hours. So that's the main things to consider. But yeah, it's a 24/7 market. So they're usually open and they're usually one-to-one. But yeah, just be wary of leverage instruments that have high volatility. So, but if you're trading CFD just to be MiFID compliant, then it's obviously a useful tool because you don't have to get individual asset custodians.
Okay. We've got another, we have quite a few questions coming in. I've got one more from Hakam. The question is, can a broker open a separate account for his clients, or it all has to go under an anonymous account? John Light, maybe you can take this one.
It'd be interesting. I probably have a couple of questions back to Hakam, but so in our platform, obviously every client gets their own account, and then up to a liquidity provider that goes through the general broker's account up to the LP. If the question is more around custody and wallets for spot crypto, generally most custodians offer one large account for that broker or that institution, and all of the client's deposits go underneath that one account. But we are seeing some custodians have the concept of sub accounts where clients can be segregated at the custodian, and a lot of brokers in the US, this is actually a requirement that's coming through where those have to be segregated. So there are some custodians out there that are doing that.
Cool, thank you. Let's see, we've got a few more. Henry, what blogs, websites would you recommend for trends and industry news, since it sounds like you are always on top of what's going on in
yeah, crypto? Within reason. So I think like if you're technical, then you can actually follow the dev teams directly. So usually, as I said, although crypto is anonymous, someone like Ethereum Core, you can follow Vitalik in that case. And even Bitcoin, where Satoshi Nakamoto is not known, the Bitcoin Core is still a known entity. So they do announcements and stuff. So they all have a website. So make sure you follow the right websites. If you're not that technical, I would say the coverage is massively improving. I think Bloomberg cover, they have a crypto section. Financial Times have a crypto section, which is quite in depth. If you want very crypto specific stuff, then there's I like Paul from CoinScrum. He's got a good platform, which is good. Into the Block, kind of there just, and then you've got sort of CoinDesk and these other specific news outlets. I say don't overload yourself, just like focus on a few core ones. But I would just say that the coverage now done by actually the Wall Street Journal, they reached out, they have a special, they have basically assigned journalists to this now. So 5 years ago, there's nothing, but you could probably actually subscribe directly to the stuff. If it's kind of big macro, then the big news outlets still cover quite well now.
When you mentioned Bloomberg, do you mean like the terminal, or we're talking about just the Bloomberg website with just like a news subscription?
Yeah, so I think they're pretty reasonable now. And then Forbes have a big crypto section, which is they kind of also cover more exotic stuff, but I don't know exactly very many journalists from there. So, but yeah, it just seems it's growing traditional media.
Yep. And if I can interject and say, Finance Feeds also covers crypto, so you're more than welcome to read us.
Well, we're not over pushing ourselves. That's what I was trying to do. So yeah, Finance Feeds.
Yeah, we've got one more question from Nora Bidin here. I'll just sum up the question. We all know that hacking is still an issue, right? I think in some respects in the crypto space. Is there solutions for basically, protecting crypto assets, or perhaps a crypto platform and things like that from hacking? John Light, maybe you can speak a little bit more to this.
Yeah, so this is obviously a big area that we invest a lot in security. So all of our trading platforms are on secure servers with all of the standards that you would expect, kind of over the standards that you would expect. Also for our platforms, like I mentioned earlier, when clients are depositing crypto, we don't actually take that off of the custodian, so that stays in a secure wallet, and we get updated of deposits and withdrawals, and we make that change in our platform. So that's really where a lot of the security concerns are around, and like I said, there's a lot of institutional grade custodians coming into play here that are doing everything right from a security perspective to get insurance policies, to make the regulators happy. So I would say if you have concerns about security, this is somewhere that you should really take a look into, because if that's the place that you could lose crypto out of wallets and things like this.
Cool, thank you, John. We've got another one here from Basil. He's asking, is cash and an eVoucher payment method something you see as a viable option for pure crypto exchanges? He doesn't mean crypto CFDs. He's asking about purely buying physical cryptocurrencies and assets. Henry, maybe you can take this one?
Yeah, I mean, I was just going to issue more of a warning for that one. So just saying, previously, obviously, Tether was the main way to kind of do payment rails, which is why Tether, even though you hear all the news about it not being fully collateralized as a stable coin, it still has like kind of large success. I would say that a lot of the core crypto ecosystem was kind of left out from the financial institutions. So they had to develop their own payment systems like this. I know of a few wallet providers in Africa kind of going for this model, but I don't think, I think these will run afoul of a lot of KYC and the regulatory issues. So if the jurisdiction's like a main jurisdiction, then yeah, you may struggle to remain compliant offering that. So, but yeah, it's understandable because yes, it's difficult to get fiat payment rails if you're dealing in crypto. So that's but it usually you need to conduct full KYC on the clients. So if there's obfuscation via vouchers and it's perceived like that, it won't be looked on that great, I don't think.
Cool. Thank you, Henry. John Willock, I've got one for you from Osemo. Do you offer services that enable brokers to deliver data analytics information to retail traders to support their trade executions?
So the answer is yes, absolutely. That is the bread and butter of what we offer. So that's something that could be offered on a standalone basis. I'd invite that audience member to take a look at what we have on dxFeed.com. But nevertheless, anything from small standalone widgets right through to a full display solution, including any kind of chart and visualization tools and any number of underlying analytics that are typical in the traditional securities trading space can be replicated for the sake of what is available in the digital asset space as far as quantification and description of instrument characteristics of market conditions. Best execution, again, there's elements of perhaps what is your legal definition of that, depending on your regulatory regime or your jurisdiction or your own opinion, just based on the fact that those may not be governed by any kind of regulation. But there is absolutely the ability for us to be able to take whichever data sets, whichever markets which are within that realm for you, and to produce for you an ability to display the fact that you in fact executed at what would have been, in your view, that best prevailing price at that moment in time, which would be similar to, again, anything that's demanded under the MiFID regime or other global regimes, as far as trying to show your clients you've achieved the best possible price for them. And naturally, these are things that within the Devexperts side of the business, as far as these crypto exchange platform tools and CFD broker type tools that the company offers, that these would naturally be included as well. So from a content perspective, any kind of analytics that a client might need can be either custom built or probably something we have off the shelf as well.
Thank you, John. Henry, I think you want to interject a little about the last question you answered.
About the fiat side, it's like, yes,
sure,
of course, all reputable crypto exchanges will settle and take fiat, but the broker on the other side, if you're doing crypto, you need to get a banking relationship, or which is possible. It's just you'll have to find or an IBAN. So there's companies out there that will offer IBANs and the payment rail side, but you have to be careful because most banks will not take a crypto firm. So there are out there too. But yeah, cool. We'll take fiat, for example. That's bread and butter standard. But we have very strong banking relationships to maintain that. Otherwise, it can be quite hard to maintain top tier banking relationships.
Cool. I have a few platform questions here, John Light. If you can talk about one of these. One of them, real quick, is it doesn't seem like joint accounts are something that are available for retail customers today on crypto trading platforms. Is that a solution that is forthcoming?
So it's actually the first time I've seen that request come in. So we build platforms for brokers, obviously. We have our SaaS platform that doesn't have that offering in there, but we do have an enterprise offering where you can take our platform and then we can assign a team of engineers to work on that. So if that's something that your particular brokerage needs, you can take enterprise and we can do custom work to add that in. But yeah, probably wouldn't be too much work.
Cool. And there's actually one more here. Are there systems in place to offer crypto products to retailers in regions having local restrictions? I think that's also from a platform or trading perspective, John.
Yeah, a similar kind of answer. So we have clients that are in regions all over the place. So we're particularly with our SaaS platform, if you have restrictions that it has to be hosted in that particular country, we can deploy it in different regions in AWS, for example. If there's something more specific for a region, some kind of reporting, this can be added. Our platform has APIs into pretty much everywhere. So anything like that can be added in if needed.
Cool. Thank you. And one more question about trading platforms. I personally thought that this has to come up. MetaTrader 4 and MetaTrader 5, are they fully applicable with crypto trading? Hakam asked this question. And if they are compatible with crypto trading, MT4 and MT5, what is the best means of connecting crypto trading through normal bridges or something like that? Yeah. Not sure, John, do you want to take this one?
Yeah, I know we only have a minute left, so I'll try and be quick. So sure. Yeah, it's certainly possible, and there are definitely companies that will help with this. Crypto CFDs over a bridge, but the problem is that it doesn't really support everything. MT4 doesn't really support everything that a broker is going to need in the long term. It will become a pain. So we all know that Meta stopped support for MT4 a long time ago. You can only use what's there today. For example, if you want to add more frequent financing in, you can't do that. Like I said, crypto CFDs are possible, but crypto spot, you're going to be making a lot of sacrifices. There's no support for multi-currency accounts, and quite often with MT4, things are squeezed in that might not be ideal. So yeah, you might not be starting from the best place.
Yeah, you may need to rebuild some of the back office as well. It's quite, yeah. We get the inquiry quite a lot with our side, but yeah, I think there's a few workarounds, but it's not ideal with crypto because it's the delivery versus payment problem. And so yeah, it's really slight. It can get a bit messy. CFDs are fine. That's why sometimes people go for CFDs straight off the bat because they work. But yeah.
Cool. Well, I want to thank you guys. Thank you to the panelists. Thank you to the attendees for coming to our webinar today. I hope everybody enjoyed our fruitful discussion. You guys, hopefully everybody has seen, I've screen shared the contact details for Devexperts, dxFeed, GCEX, as well as finance feeds if you have any questions for us, or want to do something like this with your company. Feel free to reach out to everyone individually if you have additional questions. It seems like there are quite a few quite a few interesting questions that people have had for launching crypto. So hopefully one of our panelists or their team can help continue the discussion with you individually and help you out. I personally want to thank the panelists for joining me today, and hope that we could do something like this in the very near future. So I'll leave the screen share up for a minute here so that you guys can take down the information. And again, everybody who registered and attended the webinar, we will certainly have a recording of the webinar available very soon. And we will email that to everyone. And you could also sign up for our YouTube channel, our Twitter, our LinkedIn, and follow our company updates and media updates as well. So thank you everyone for joining us, and have a very lovely Thursday.
Yeah, thank you so much for the invite and Nikolai for hosting.
Thank you.
Thanks, bye.
That's right.
Cheers.